everyone, I am Ashley Nicole Peña and I will be discussing inclusions and exclusions from the gross income under Section 32 of NIRC or National Internal Revenue Code, which is business income, gains derived from dealings in property, interest income, and rental income. Under business income, there is bad debt recovery, tax refund, and cancellation or condonation of debts. But first, let us know what is business income. So, business income is a gross income derived from the conduct of trade or exercise of profession. It may arise from the sale of products or services. For example, fees received by a professional person and rents received by a person in a real estate business. Business income is taxed at progressive rates on net business income, or income from the practice of profession, net income after deduction of certain specified expenses and any excess of personnel and additional exemptions over compensation income. It is important to remember that gross income under this item means gross sales less cost of sales for seller of goods, or gross receipts less cost of service for the seller of service. Of course, after considering the discounts, allowances, or returns. Under business income is bad debts recovery. Tax benefit rule states that taxpayer is obliged to declare as taxable income its subsequent recovery of bad debts in the year they were collected to the extent of the tax benefit enjoyed by the taxpayer when the bad debts were written off and claimed as a deduction from income. For example, X company has a business-connected receivable amounting to 100,000 pesos from Y who was declared bankrupt by a competent court. Despite earnest efforts to collect the same, Y was not able to pay, prompting X company to write off the entire liability. During the year of write-off, the entire amount was claimed as a deduction for income tax purposes, reducing the taxable net income of X company to only 1 million pesos. 3 years later, Y voluntarily paid his obligation previously written up by X company. Should the recovery of bad debt previously written up be considered part of X company's gross income? The answer is yes. Applying the tax benefit rule, X company should include the amount recovered in the computation of its taxable income in the year of recovery, considering that it was able to get full tax benefit 3 years earlier. Bad debt recovery is a payment received for bad debt that was written off and considered uncollectible. Next to it is tax refund. Tax refunds are taxable if the tax, when paid, was deducted from gross income, local taxes, and fringe benefit tax. Taxes which were not previously allowed as deductions from the gross income should not form part of taxable income when refunded. The following tax refunds are not taxable, including income tax except fringe benefit tax, estate tax, donor's tax, special assessment, stock transaction tax, and income tax paid to a foreign country if the taxpayer claimed a credit set for such tax in the year it was paid. Take note that using cash method accounting, tax refund is reported as income in the year it was received. For accrual basis accounting, tax refund was reported in the year the refund was ordered. The last one is cancellation or condonation of debts. Income can come in many forms, including the cancellation or condonation of debts. The following tax rules shall be observed with respect to cancellation, condonation of debts. Table 8 shows the tax treatment of debts cancelled or condoned. Applicable tax subject to basic income tax. The reason for the cancellation is that if services were rendered by the debtor in consideration of which the indebtedness was cancelled by the creditor. Subject to donor's tax. If the creditor, without receiving any consideration from the debtor and purely as an act of liberality, cancels the indebtedness. Subject to 10% final tax. If the debtor is shareholder of the corporation that cancels the indebtedness, such cancellation constitutes indirect dividend. 32A Item 3. Gains derived from dealings in property. Gross income derived from dealings, sale, barter, or exchange in property includes all income derived from the disposition of property, real or personal, for sale or in exchange of other property or bought, which results in gain or loss. The gains that form part of the gross income are those earned from the sale or disposition of ordinary assets. The gains from the sale of capital assets are therefore not included because the same are subjected to final tax. Section 32A Item 4 Interest Income. Generally, interests are taxable income unless exempted by law whether or not usurious. Interest derived from lending money, goods, or credits from one person to another, or interest earned in normal conduct of trade or business are subject to basic tax. Those interests that were not subjected to final tax are part of the gross income. For example, the interest earned on the pautang of the Bombay from the people is taxable. On the other hand, the interest earned by the Bombay on his bank deposits are not part of the gross income because it is already subjected to final tax. Section 32A Item 5, which is rental income. Under rental income, there is non-taxable rent, leasehold improvement, and pretermination of lease. So, rental income. Section 32A Item 5 of the Tax Code provides that rent paid by the lessee for the use or lease of property is taxable income to the lessor. Rent is the amount paid for the use or enjoyment of a thing, real or personal, or right. Rent income may be in the form of first, cash at a stipulated price. The second one is obligations of the lessor to the third persons paid or assumed by the lessee in the consideration of the contract of the lease, such as real property taxes assumed by the lessee on the property being leased, insurance or other fixed charges. Such payments shall be considered rental payments to be reported by the lessor as part of its taxable income. And the last one is advancement payment, which may be prepaid rent or a security deposit that is applied to a rental, is a taxable income of the lessor. Of course, the rents form a part of the gross income. In this case, it should be gross rentals less cost. For example, depreciation, salaries, maintenance, and etc. Under rental income is non-taxable rent. Advance rentals representing option money for the property as well as security deposits to ensure faithful performance of certain obligations of the lessee are not considered as income on the part of the lessor. Next is leasehold improvement. A leasehold improvement is an improvement made to a leased asset. A leasehold improvement is a change made to a rental property to customize it for the particular needs of a tenant. It may be done by the landlord or a tenant. Painting, installing partitions or customized light fixtures, and changing floors are leasehold improvements. Outright method or lump sum method, the fair market value of such buildings or improvement. The computation used is FMV upon completion of the improvement. Another one is spread out or annual method. To spread over the life of the lease the estimated depreciated value of such buildings of improvements at the termination of the lease and report as income for each year and list an aliquot part thereof. For computation of annual income is equals to VB end of list term over remaining term of the list. The last one under rental income is pre-termination of lease. If for any reason of other than a bona fide purchase from the lessee by the lessor, the lease is terminated, the lessor is realized additional income for the year to the extent that the value of such improvement exceeds the amount already reported as income on account of such improvement. To compute pre-termination of lease, FMB upon pre-termination less income already recognized or reported. That's all and thank you.